The most powerful price in retail may be $0 today. Not $0 total, $0 at the exact moment your brain is deciding whether the purchase hurts. Buy now, pay later takes one price and divides it into 4 smaller decisions. A $200 purchase becomes $50 today, then 3 more payments that belong to a future version of you. The product arrives immediately. The cost arrives in pieces. And that is why the zero-down economy can have a very expensive ending. Buy now, pay later is usually a short installment loan. The familiar version splits a purchase into 4 payments, often without interest when payments are made on time. Compared with a high-interest credit card balance, that can be a genuinely useful product. The schedule is clear. The debt can be paid quickly. Some plans have no interest. Consumers without traditional credit may gain access to a structured payment option. So why do retailers place the button beside the price? Because smaller payments change buying behavior. The shopper is no longer comparing the full purchase with the money available today. The shopper is comparing the first installment with today's discomfort. $50 feels different from $200 even when the total is exactly the same. Retailers value any payment method that increases the chance of a completed sale or supports a larger basket. The lender can earn a fee from the merchant and, depending on the product, may also earn late fees, interest, or other revenue. The customer gets flexibility. The merchant gets conversion. The lender gets a claim on future payments. Every participant gets something. The risk appears when several small claims land on the same paycheck. One Pay in 4 loan is easy to understand. 4 loans from 3 apps are not. The Consumer Financial Protection Bureau found that most buy now, pay later borrowers in its matched research sample had multiple simultaneous loans at some point during the year. About 1/3 used multiple BNPL lenders. Each checkout can be affordable on its own. The month can still be unaffordable in total. This is payment stacking. Imagine 4 purchases: shoes, groceries, a phone accessory, and a birthday gift. Each creates a different schedule. The payments may come from the same debit account on different days. A new purchase begins before the old one ends. A refund may arrive after the installment is taken. The borrower does not experience one large bill. The borrower experiences a calendar full of small withdrawals. That matters because household budgets are not spreadsheets with perfect timing. Rent arrives monthly. Pay may arrive weekly or biweekly. A car repair can appear without notice. A bank balance that looked sufficient on Monday may be too small when 3 automated payments arrive on Thursday. The total debt can be modest while the timing creates a crisis. Traditional credit cards make debt visible in one account and one statement, although the interest can be punishing. Buy now, pay later can keep each purchase separate and each payment small, which reduces the emotional signal that spending has accumulated. The interface is part of the financial product. That does not mean people are being hypnotized. It means product design changes which number receives attention. Retail has always done this. Car dealers emphasize monthly payments. Phone companies spread devices across plans. Subscription services display a monthly rate instead of an annual total. Buy now, pay later applies the same logic at checkout. Shrink the visible commitment until resistance falls. The market has grown rapidly. In its 2025 market report, the CFPB said the 6 large providers it surveyed reported tens of millions of consumers using at least one BNPL loan in 2023. The exact number of distinct people is difficult to measure because one person can use several providers. That measurement problem is itself important. If lenders see only part of a borrower's activity, each provider may approve a payment schedule without seeing every other schedule competing for the same income. The system can understand the transaction better than it understands the household. There are other complications. Returns can cross with installment dates. Disputes may be handled differently from credit card disputes. Missed payments can lead to late fees or account restrictions, depending on the provider and plan. Longer-term installment products may charge interest, and while the 4-payment version looks simple, the category increasingly includes different loan structures. The label stays friendly. The contract still matters. Here is the counterargument that should not be skipped. Used carefully, BNPL can be cheaper and clearer than revolving credit card debt. It can smooth a necessary purchase across 2 paychecks. It can give a buyer a fixed payoff date instead of a minimum payment that barely reduces principal. For a disciplined customer with stable cash flow, the product may do exactly what it promises. The danger is not installment payments themselves. The danger is using the first payment as if it were the price. A better rule is to record the full purchase in the budget on day 1. If a $200 item does not fit, 4 $50 installments do not make it cheaper. They only change the timing. Second, keep all installment plans on one calendar. Third, avoid starting a new plan until an old one ends. Fourth, use a dedicated spending account or maintain a buffer so automatic withdrawals do not collide with essential bills. Fifth, read the return, late fee, dispute, and credit reporting terms before checkout, not after something goes wrong. And finally, ask the most revealing question in consumer finance. Would I still buy this if the screen showed the full price? There is a second test for necessary purchases. If the item is essential and cash is short, compare BNPL with every real alternative, not with an imaginary world where the money is already available. A zero-interest installment plan may be better than an overdraft, a payday loan, or a revolving credit card balance. The correct choice is the least costly safe option in the situation that actually exists. But even then, the payment schedule should be tested against the lowest expected account balance, not the average balance. The merchant's incentive also helps explain where the option appears. The provider can charge the retailer for delivering a customer who is more likely to complete the purchase. That means the financing cost may be embedded in the economics of the sale, even when the shopper pays no explicit interest. Free describes the loan's price to the borrower under certain conditions. It does not mean the system operates without revenue. Refunds show why the details matter. If an item is returned after an installment has been collected, the timing of the merchant refund, lender adjustment, and bank deposit may not match. Keep the receipt, confirm the plan balance, and do not assume the next automatic payment has been cancelled until the account shows it. The same care applies to disputes. Credit cards developed standardized consumer protections over decades. BNPL protections and reporting practices have been evolving, and different products may not behave identically. A familiar button can sit on top of a contract that deserves the same attention as any other loan. Finally, measure the opportunity cost. 4 payments do not only claim cash, they claim flexibility. Future income already assigned to old purchases cannot cover a new emergency, take advantage of a discount, or move into savings. The most expensive ending may not be a late fee. It may be arriving at a genuinely important choice with too many small promises already attached to the paycheck. That is why the safest installment plan ends quickly, remains visible, and is used for a purchase that would still make sense at full price. The zero-down economy works because tomorrow's money feels less real than today's product. But tomorrow always becomes today. The purchase arrives in one box. The price arrives 4 times. This is price tag theory, the money behind everyday life.